In early 2025, the bills started coming due. The company that owned Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman all at once could not pay its bills. Saks Global had been assembled for roughly $2.5 billion. It controlled three of the most storied names in American luxury retail, and within months of closing the deal, it was rattling suppliers, ghosting landlords, and burning through cash at a pace no one had publicly modeled. This was not a slow decline. It was an implosion engineered at the moment of what was supposed to be a triumph. To understand how a $2.5 billion luxury empire started missing payments almost immediately, you have to go back to what Saks actually was before the deal. Saks Fifth Avenue was founded in 1924 on the corner of 5th Avenue and 50th Street in Manhattan. Its founders, Horace Saks and Bernard Gimble, made a specific bet that wealthy Americans wanted a single destination for European fashion and American luxury goods. That bet was right for decades. By the 1990s, Saks had expanded to dozens of locations and was synonymous with aspirational American retail. In 1998, Profits Incorporated acquired Saks for roughly $2 billion and rebranded as Saks Incorporated. The flagship store on 5th Avenue pulled in tourists, celebrities, and the genuinely wealthy in roughly equal measure. Then in 2013, Hudson's Bay Company, the Canadian retail group, acquired the entire Saks chain for roughly $2.5 billion. Hudson's Bay already owned Lord and Taylor. Now it had Saks. It was building a luxury conglomerate, but HBC had a habit of seeing real estate first and retail second. The Saks flagship building on 5th Avenue alone was valued at over $1 billion. That number mattered more to them than the merchandise inside. That instinct to treat luxury stores as property plays would later define and doom the Saks Global structure. Meanwhile, across town, Neiman Marcus was writing its own troubled chapter. Neiman Marcus had been taken private in 2013 by Ares Management and the Canada Pension Plan Investment Board for roughly $6 billion. $6 billion. For a luxury department store chain with roughly 40 locations. That price loaded Neiman Marcus with debt it would never successfully shed. Neiman Marcus went public in 2013, tried to sell itself in 2018, and filed for Chapter 11 bankruptcy in May 2020, deep in the pandemic, with roughly $5 billion in debt. $5 billion. It emerged from bankruptcy in September 2020, technically restructured, but carrying wounds that would not heal. The debt was reduced. The ambition was not. Now, enter Richard Baker. Baker had run Hudson's Bay Company for years. He understood luxury real estate. He believed scale could solve what bankruptcy had not. In 2023, HBC began serious talks to acquire Neiman Marcus Group out of bankruptcy and merge it with Saks. The logic on paper was seductive. Combine two struggling luxury giants, cut duplicate costs, dominate the high-end American department store category. Amazon and Salesforce invested. So did LVMH's venture arm. The deal had prestigious backing. In July 2024, the acquisition closed. Saks Global was born. It controlled Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman. Three iconic American luxury names, one holding company. What it also controlled, though no one said this loudly, was an enormous pile of inherited debt and a real estate structure designed to extract value rather than support retail. The merger itself was built on debt, not on a clear strategy for how these three brands would coexist without cannibalizing each other. Saks Fifth Avenue and Neiman Marcus served nearly identical customers. Both positioned themselves at the very top of American luxury. There was no clean division of territory. The combined company also inherited Neiman Marcus's remaining liabilities. Even after its 2020 restructuring, Neiman Marcus brought billions in outstanding obligations into the new entity. That weight would prove impossible to outrun when revenue pressures arrived. But the structural flaw that would most directly trigger the cash crisis was the real estate arrangement. Hudson's Bay had long pursued a strategy of separating the retail operation from the real estate it occupied. The idea was to spin store properties into separate vehicles, unlock their asset value, and have the retail business pay rent back to those property entities. This is called a sale-leaseback. In theory, it frees up capital. In practice, it creates a retailer that must pay rent to itself or to investors in perpetuity. When sales are strong, rent is manageable. When sales slow, the rent becomes a trap, and sales slowed. By late 2024, luxury spending across the United States had softened materially after years of post-pandemic elevation. High-income consumers, spooked by equity market volatility and interest rate pressure, pulled back on discretionary luxury purchases. LVMH reported slowing growth. Burberry issued a profit warning. The entire luxury category decelerated. Saks Global had chosen the worst possible moment to take on maximum financial complexity. The company began missing payments to vendors in early 2025, not small vendors. Major fashion houses that supplied the merchandise those stores needed to compete at the luxury level. When you miss payments to Chanel or Prada, word travels fast. Vendors began tightening terms. Some demanded payment on delivery. Others reduced shipments entirely. A luxury department store without fresh merchandise is not a luxury department store. It is a very expensive room. Landlords grew anxious next. Reports emerged of missed or delayed rent payments at multiple Saks and Neiman Marcus locations. The company that had separated its retail operations from its real estate now couldn't pay its real estate. The irony was structural. The very financial engineering meant to unlock value had created a rigid, unforgiving cost base. Saks Global began closing Neiman Marcus locations. Stores that had operated for decades started going dark. Employees who had survived the 2020 Neiman Marcus bankruptcy found themselves navigating a second collapse within 5 years. The company brought in restructuring advisors. That is rarely a sign of confidence. Internally, executives were attempting to stabilize vendor relationships by promising accelerated payment timelines they could not always meet. The company explored asset sales. It looked at whether pieces of the Bergdorf Goodman operation could be separated and monetized. Bergdorf Goodman, the most profitable and prestigious of the three nameplates, had always stood apart. Now, it might be sold apart. The full numbered list of failures had materialized exactly as the company's structure had guaranteed. First, a merger built on debt, not strategy. Second, Neiman Marcus brought billions in liabilities that restructuring had trimmed, but never eliminated. Third, real estate spin-offs had stripped the stores of the one asset that could have supported emergency financing. Fourth, luxury spending cooled at the exact moment Saks Global needed consumers to spend with maximum enthusiasm. Fifth, vendor and landlord trust collapsed once the missed payments began, creating a feedback loop the company could not break. Each failure amplified the next. That is how implosions work at this scale. There is a version of this story where the Saks Global deal makes sense. If luxury spending had remained elevated through 2025, if the real estate separation had produced clean, stable rent obligations, if vendors had extended patience. But businesses are not built for the perfect scenario. They are stress tested by the imperfect one. Saks Global had no margin for error, and the world offered no cooperation. The names on those buildings still carry a century of meaning. Saks Fifth Avenue opened in 1924, Neiman Marcus in 1907, Bergdorf Goodman in 1901. Combined, they represented over 3 centuries of American luxury retail history, assembled in one structure, undone in under 1 year. Go back to February 2025 when that Wall Street Journal story appeared about missed vendor payments. At that moment, the deal was barely 7 months old. 7 months from triumphal acquisition to cash crisis is not bad luck. It is a structure failing under the weight it was designed to carry. Private equity and retail have a complicated history. The Toys R Us bankruptcy, the Sears collapse, the Sports Authority liquidation. The pattern is familiar. Load a brand with debt, extract value through financial engineering, and hope the underlying business is strong enough to carry it. Sometimes it works. Often it doesn't. And when it doesn't, it is always the stores, the workers, and the vendors who absorb the damage. Saks Global was not destroyed by Amazon. It was not disrupted by a startup. It was not outmaneuvered by a smarter competitor. It was assembled with too much debt, too little operational clarity, and a financial architecture that had no room to breathe. The ambition was real. The plan to consolidate American luxury retail, to create something that could compete globally, was not irrational. But ambition without liquidity is just a story you tell investors before the payments are due. 3 of the greatest names in American luxury retail, one holding company, 7 months to the first missed payment. The lesson of Saks Global is not that luxury is dying. It is that complexity kills what simplicity could have saved. The most dangerous deal in business is the one that looks like a victory on the day it closes.